If money is mostly digital these days, how do banks' governments ensure that no one can create money out of thin air? Ledgers. They need to balance. If money appears in a location, it needs to have been deducted from some other location. If the ledgers don't balance, alarm bells go off. Banks are regulated and audited, and it's not that complicated for them to ensure that no money has mysteriously appeared from nowhere. Basic double-entry bookkeeping would check that the sum total of debits and credits adds up to zero, with everything accounted for. For your account to be credited with $1 billion, those same $1 billion would need to be debited from somewhere. If there's an account that's now in $1 billion of debt, because it was created to be the source of funds to pay you, then that will be noticed. If there are 1 billion accounts that are each down one, that will still also be noticed. As a general rule, banks are going to pay attention and investigate when their books show unexpected billion-dollar losses or liabilities. Auditing. Lots and lots of auditing. This isn't a new problem. When banks were on paper, nothing stopped a banker from adding a few zeros to the ledger. Banks have never actually kept all their deposits as cash. What stops that kind of thing is constant monitoring and auditing of records. You must account for every penny, where it came from and where it went. $1 billion into my bank account coming from where? For every dollar that gets credited somewhere, it needs to be debited somewhere else. And even if you manage to get around that in some way, an account increasing by $1 billion will most certainly draw some attention, and that transaction will be checked by humans and compliance departments very quickly. Banks create money out of thin air all the time. Year back from my banking days, they can borrow 5x amount of deposits in my country. Banks create money out of thin air, and they do it all the time. And they replace hacked stolen money all the time too. And have you heard of crypto? I think 2025 may be a bit of a shock to you. Google QE, Google debt cancellation, etc., etc. Ledgers and processes have been in place for a while, thankfully, and regulations and audits absolutely help make sure things stay true for now at least. All money is simultaneously credit and debit. It's not just an asset that you hold, it is also, simultaneously, a liability held by the institution which issued it. When you borrow money, that asset is created out of nothing on your balance sheet, but so is the corresponding liability on the bank's balance sheet. If you then go to the bank to pull out cash, the bank has to redeem that liability for actual hard cash. No bank is going to just create a liability on themselves for no reason. In the real world, when money is created through lending in this way, there's also a loan that's created. And while money is your asset and the bank's liability, the loan is the other way around. It's your liability and the bank's asset. In some ways, money does get created out of thin air, but in a controlled manner. Best example is when banks do it by taking deposits and lending money. Let's say you deposit 100 into the bank and then they lend that out to someone else. Now they're your 100 and that person has you 100, so now there's 200 in the system. Fractional reserve banking and other regulations hedge that not everyone will want their money out of the bank at the same time to prevent the run on banks like was experienced during c. 1929. Hence it's so scary that politicians arbitrarily make changes woefully consulting experts, but rather do it anecdotally like it is their personal finance. Personal finance and national economics don't operate the same way, i.e., running in debt is not good personally, but not necessarily bad nationally if the debt goes into assets that increase total GDP net positive growth. Central banks like the US Federal Reserve handle the process of clearing bank-to-bank transactions and also require every bank in the network to have a specified percentage of the number of dollars on their balance sheet as cash in a vault somewhere required reserves. If the reserve ratio is 10, then to loan you $1 billion, the bank would need to have $100 million in the vault or risk getting shut down and locked out of the network. Note that the cash in a vault might be more abstract these days, with the central bank just keeping tallies and printing actual currency only when necessary for withdrawals. Government do create it out of thin air. Via la Bitcoin : the oldest known text found was a payroll record. There is one thing true throughout the history and true now, and even true when AI rules them all. Humans, and hence AI, value mulas so much, perhaps value them even more than human lives, possibly including her own. People count their money every day and will notice anything missing in split seconds. The Federal Reserve literally does create money out of thin air. All transactions are recorded and preserved in the various bank and business ledgers. They can trace transactions easily. This is why counterfeit paper money is so dangerous. It could in fact be entered into a bank and then digitally transferred, meaning that the real digital valuation is no longer tied to the counterfeit, and that the counterfeit gets distributed to thousands of folks in smaller demonizations, and the original counterfeiter has clean digital currency that they don't have to worry about. All debts are money created out of thin air. How did banks do this before the internet is a better question. In software development, there are transactions in certain languages, meaning the total has to be retained, so you can't just add 10 to an account out of thin air. And a software written that way would never survive audits. Your answer is in your question. The word transfers indicates movement. Where does the money transfer from? Cryptography lol.